Dogecoin's new bull case is being built on chart patterns, not on a fresh network catalyst. That matters because technical setups can drive attention, but they are fragile when the underlying thesis depends on pattern recognition and ambitious extension targets instead of new fundamental demand. The tension is whether the supported catalyst is strong enough to survive the first reaction and keep drawing buyers once the easy excitement fades. The article described an analyst calling the end of an ABC correction, a bullish MAC divergence, and a breakout from a short-term triangle. It said Dogecoin was around 10 cents at the time of the analysis. For searches like Dogecoin poised rally, that matters because technical setups can drive attention, but they are fragile when the underlying thesis depends on pattern recognition and ambitious extension targets instead of new fundamental demand. Those confirmed details matter because they tell you whether this move came from one headline or from several pressure points landing together. Long-range targets above $2 and even higher zones were framed through Fibonacci extensions and historical fractal comparisons. In plain language, the thesis is that Doge may have finished a correction and could be starting a new trend leg if past pattern behavior repeats. That is a chart-based read, not a confirmed cash flow story. A fractal is a chart pattern traders compare across cycles, but similarity is not proof that the same outcome will repeat. That mechanism is the part traders can miss when they only look at the chart. This mainly affects momentum traders and retail holders because technical narratives can attract fast participation even when nothing fundamental changed on-chain. This is why the move can look larger or weaker than one headline suggests. In stories like this, the structure underneath the price often matters as much as the candle itself. The obvious uncertainty is that fractals and extension levels are not guarantees. They are pattern tools, and they fail quickly if broader market conditions turn against them. Dogecoin poised rally is the phrase tied to the setup, and the obvious uncertainty is that fractals and extension levels are not guarantees. They are pattern tools, and they fail quickly if broader market conditions turn against them. A market can move before those answers arrive, but it usually cannot keep the same pace forever without them. The important point is that price action and structure are not the same thing. A sharp move can be real while still resting on fragile conditions that have not been fully settled. That is especially true when leverage, concentration, or technical positioning is doing part of the work. Watch whether price can hold the breakout structure and whether shorter-term momentum confirms the setup before the market starts talking about distant targets as if they are already in motion. Timing matters here because the next clean signal can separate a durable move from a temporary burst. If that signal confirms the story, confidence can rebuild quickly. If it fails, the move can unwind just as fast. The broader consequence is that traders are not only pricing a chart. They are pricing confidence in the mechanism underneath the chart, whether that mechanism is supply, leverage, collateral, or narrative follow-through. That is why this story matters beyond one intraday move and why follow-through is the real test. Watch whether price can hold the breakout structure and whether shorter-term momentum confirms the setup before the market starts talking about distant targets as if they are already in motion. The practical takeaway is simple. Watch execution, watch the key level or flow that matters in this story, and do not treat an early move as proof that the final answer is already known. The market still has to validate it.